गोपी स्क्रीन தெரியாதா? गोपी स्क्रीन தெரியாதா? ஷேர் பண்ணது. I'm not able to hear you. Can you see my screen? Okay, super. Then I'll just start the meeting. Good morning, everyone. Thank you for tuning in. We'll just give it a few more minutes for people to join in because I still see the numbers going up, and we can start maybe at 11:05. I hope my screen is visible to everyone. I'll just begin in another 2 minutes. And until then, thank you for your patience. Okay. Uh, so let's begin. Today, one of the things that we wanted to talk about was how multi asset funds perform in different markets. So, if we think about where we are in the market cycle, 2024 was a very different year from what we're expecting 2025 to be. So, a lot of things have actually changed. So, in 2024, you had a lot of FII interest in India. This was an election year, not just for India, but across the globe. It was a big election year. There was been a lot of regime changes also from a political perspective in 2024, and that is now behind us. And as we move into 2025, you're seeing a different set of geopolitical relationships crop up and challenges also arise in the same context. So, one thing which took markets a little bit by surprise was the Trump victory, because broadly through 2024, the expectation was that the presidential outcome would be very neck to neck, and it would be difficult to see who was the elected leader, plus whether there would be any sort of uh, instability or lack of a clear political mandate on the US side. But ever since Trump has come into power, I think there's been a lot of positive sentiment surrounding the US economy. Broadly, the idea being that you're expecting one from fears of a recession, you've now gone into a phase of the US is going to grow at a steady pace. At the same time, the view on inflation in the US has changed. So the Fed's commentary through the first half of 2024 was that yes, we're worried about inflation, but we're also worried about labor markets. And then you saw one shift towards we're worried about what's happening in the labor markets. And then finally, towards the end of the year, you saw them flip back, saying that now we're keeping our eye on both inflation as well as unemployment numbers. So with this kind of backtracking that the Fed has done and the lowering of expectations in terms of how much and how many rate cuts are going to be there in 2025, you've actually seen a revived interest in US markets, and money is moving out of, say, emerging markets like India and China into the US markets. So that's one big shift that you've seen. Also, from a domestic perspective, you had the first half of last year with very constrained spending from the government, primarily because you had election outcomes. Then post-election, there was a lull in spending, and now you're seeing that government spending pick up. So when we look at the GDP numbers, we also need to keep this data point in context when we're trying to understand, is the Indian economy really slowing down? Now, the other thing is in terms of what the India story has been and how that narrative has been peddled around, the expectation has been anchored that the Indian economy will grow at 7.5%. Now, clearly, the data, as well as in terms of what is a long term sustainable number, maybe 7.5 is too high, and we might be closer to 6.5%. Now, that so again, there's a shift in expectations that has happened. You're seeing this also in terms of corporate earnings, in terms of how they're able to grow their revenue numbers, etc. So when we look at this in the new context, I think we also need to understand that many things are actually changing at the same time. Now, investors normally want a solution or an investment solution where they don't have to worry all the time about this context, because today they'll publish something about the GDP data, then next quarter it'll be something else, then you'll talk about inflation, and these things keep changing, right? So, in this context, that is what we were looking at, and we were trying to see how can multi-asset funds actually really perform well in different markets, in different environments, and does it really work out well for the investor? So that's the main thing that we're going to discuss in today's webinar. um, so the only thing that we can be very certain about is that everything is cyclical, right? So whether it's in terms of how inflation is going to go up and come down, whether it's in terms of how interest rates are going to go up and come down, whether it's in terms of what is the favorite theme or sector today in equity markets, or what is the favorite asset class today in financial markets, right? So regardless of what parameter you're really looking at. The only thing that you can be certain about is that cycles will come and go. What we can't predict, and that's the tricky part, and that's where it gets a little challenging, is that you don't know how long a cycle is going to last, right? So a cycle can be 3 years, it can be 5 years, it can be 7 years, it can even span across decades. And then you have mini cycles and then you have super cycles. So cycles keep changing in terms of how they function. But the fact of the matter is that as investors, we have to deal with them. There is a cyclical nature to what we're putting up with. And there's always going to be a little bit of uncertainty as to where we are in the cycle. There are some indicators that we can use to understand what's going on and where we are. But there is no certainty, right? Like you might think you're in one part of the cycle, but it could go on for much longer than you expect or shorter than you expect. So speaking of cycles, the first cycle we're going to look at is the behavioral, sorry, the first thing we're going to look at is the asset allocation clock, right? So the asset allocation clock essentially plots inflation versus growth. Now, the basic reason why we're looking at this is because as an investor in a certain macroeconomic environment, certain asset classes tend to do well. And we'll talk about why or how this works. This is a thing that was designed by Merrill Lynch, and we're just going to explain it in this slide. So if you look at a situation in the left top quadrant, you see that inflation is actually coming down and growth is actually picking up, right? So in this phase of the market, you're actually looking at cyclical growth, meaning you're seeing growth as an investment style come back because you want to bet on companies that are going to do well when the economy starts picking up. Now, this is the phase that we were in the last few years post-COVID. Then you get to the phase of overheating, where you see that inflation is actually picking up. And again, I think if you look at the last few years, this was also a phase that we were in, right? So inflation is picking up a lot. Here, you're going to be more value focused, essentially because what you want is you don't want to be paying too much for the kind of growth that you're going to have because you're going to move from a higher growth environment into a lower growth environment. And when that shift happens, you need to be very careful about how much you're paying for certain ideas. Because when that growth goes away, if you've paid too much, you're going to be spending a lot of time waiting to recover what price you paid, right? And in this environment, typically whenever inflation is rising, you tend to see that commodities will do well because commodities are more sensitive or sort of insulated from the impact of inflation rather than stocks or bonds. Then you come to the hard landing phase. So if you've been tracking the news over the last few years, definitely in the US markets, you would have heard, oh, is it going to be a hard landing? Is it going to be a soft landing? What's going to happen? Are markets going to overheat? So all of these questions. So a hard landing happens when you have high inflation or rising inflation and your growth is at the same time sort of stagnant or falling, right? When your inflation is very high and your growth is completely stagnant, then that is also called stagflation. But in this phase, typically debt tends to do well because when you have higher inflation, interest rates tend to move up. When you are looking at fixed income as an asset class, as you allocate to the top of the cycle, you tend to make both mark-to-market gains as the interest rates come down, right? So this is the time when you start allocating towards longer term debt. You can also participate on the shorter term debt segment, right? So at this point, if you're looking at commodities, you can still look at commodities because you're in a high inflation environment. You can still look at money market or defensive value kind of investment ideas. So you need to be more value conscious, you need to be in safer parts of the market. So when the macroeconomic environment is very challenging, the simple rule of thumb is you need to actually play it very safe with your investment strategies. Then you move into a more defensive growth cycle. So you start seeing some signs of recovery, especially because your inflation comes into a more favorable zone. So at this point, your bonds will start performing as you get into the neutral zone. And again, here you need to still be defensive with your investments because there's a lot of uncertainty in where your macroeconomic conditions are going to move, right? So the overall style is going to be defensive, but you can start looking away from value towards growth oriented investments as well. So this is the phase in which you have interest rate cuts because as your inflation moderates, you tend to start cutting interest rates. As the effects of those interest rate cuts kick in, then you head back into the first phase of the cycle where you're seeing revival and growth, etc., and those numbers really translating. So this is our introduction to the asset allocation clock, which teaches us one very important lesson, that there are no good or bad investments. There's just the right time to make certain investments. So this tells us that, of course, any investor can participate in any asset class and actually create a lot of wealth from that. And of course, the clock is a very neat diagram. Market cycles don't actually work in such well defined quadrants. So the idea is that you can't really say that, okay, we are exactly at this point in the cycle, and or we're exactly at this point in the clock, and this is what we need to be doing, or we can only do cyclical value and commodities because we're in the overheating phase, right? So what tends to happen is you're in multiple phases at the same time, and you need to pick your investment strategies accordingly. So now that we've talked about the asset allocation clock, I would also like to spend some time on the behavioral cycle. And this is something that we don't really acknowledge that much, but a behavioral cycle is what all of us go through, right? Most investors feel confident about doing more investments when they see proof of performance, right? And that's a very natural behavior because why would you want to put your money in something where you don't have any visibility as to how it will perform? So, at least for first time investors, proof is a very important concept. Once you're familiar with cycles, you start looking at signs and you move your expectations to future performance. So, for first time investors, it's very important to understand that performance actually comes only in the next phase. You do actions one phase earlier, right? So that's what we saw in the clock. Your performance comes in a little bit later, but you have to start your investments a little bit earlier. But if you're not guided and you're not aware of the cyclical nature of investments, and you see this in the markets based on how investors buy and sell, what tends to happen is there's a lot of buying that happens after performance kicks in, and there's a lot of selling that happens when performance fades and recedes away. Negative performance, you typically see investors either completely pausing and abandoning their investments or looking at full exits because they don't want to participate in a losing idea. Then they come back only when they see performance. So we need to shift our mindset in terms of making decisions based on risk factors and macroeconomic factors rather than based on performance factors. So this is a very important shift that we need to inculcate. So this brings us to the investor's dilemma, right? So every investor has this dilemma that they need to choose between, should I choose between being safe or having high performance, right? So we feel that we need to, at some level, create wealth as quickly as possible and at the best possible rate. But at the same time, we're not very happy losing money. And risk essentially means that more things can happen than will happen, right? At the end of the day, only one set of events occurs. But when we're standing at any point in time, it looks like 100 different things can happen before us. So when we think about the investor's dilemma, you basically see that an investor wants to save every month. They want to avoid losses. At the same time, you want to compound regularly and you want to invest at the right time, but you also want to invest in the right places, right? No investor is happy seeing that they've made a particular decision and someone else is doing better in the market because they made a different set of decisions. So we want to be in have the best of everything. So when this is the dilemma, how can we actually solve this dilemma? It's not an easy question to solve because you know that avoiding losses and aiming for higher returns is actually a very tricky balance for you to strike. And we can do this through a simple tool known as asset allocation. Now, asset allocation is the idea that if you have 100 rupees in your portfolio, you can put some money in each of the assets that we talked about in the asset clock, right? Meaning you can take some money and put it in real estate, you can take some money and put it in commodities, you can take some money and put it in the stock market, you can take some money and keep it in fixed deposits or mutual funds. And when you spread your assets across different investment products as well as asset classes, you've actually achieved a certain level of diversification in your portfolio. So, why does asset allocation actually work? Or what is it that makes asset allocation special? So, I think the first thing that we need to understand is this is based on a very landmark study on portfolio performance. And the basic idea is that, okay, the question that the researcher was asking was what makes one portfolio perform differently from another portfolio, right? So the technical way of stating that question is what are the determinants of portfolio return variability? So why does one portfolio perform differently from another portfolio? Now, if you asked any investor what they thought was causing the difference in performance, they would tell you that, I think so and so picked a better stock and that's why that portfolio did better. Or someone else might tell you that, no, I don't think it's about which stock that they bought. I think it's about when they bought that stock. If this person bought in the market bottom and the other person bought at the market top, then I think that's what has caused the difference in performance. But when we really look at the data, what actually comes out is that asset allocation contributes to 90% of the difference between one person's return and the other person's return, right? And that's a huge amount. So if you look at the results from the study, it's about 91.5% that goes to asset allocation. About 5% is based on which stock or bond or ETF or product that you chose. So that is security selection. Only about 2% depends on market timing, right? So when you bought it, does actually has very little to do with how different your returns are going to be. And 2% is roughly the other factors. So when we're looking at this, what tends to happen is investors tend to get distracted by security selection and market timing, and they put a lot of time and effort into something that's only going to contribute maybe 5 or 6% to your return differentiation. But where you should be spending more time is in asset allocation because that is a deciding factor, right? 90% of return variation is explained by asset allocation. So based on what assets you choose and at what time, you're going to actually have a very different portfolio outcome. So clearly, there is a case for multi-asset investing. Now, the thing is that investors often think that, okay, if I had invested in the Nifty for the last 30, 40 years, I would have got X returns. I would have compounded my wealth at such a huge rate that I didn't need, I didn't need bonds. I don't need an FD. Why should I invest in gold? Because you just look at the longest term returns. But what tends to happen, and this is data that DSP published, is that every asset actually goes through cycles of no performance, right? So if you're a hardcore FD investor, then I think the last probably from demonetization till post COVID, you would have had a very, very rough time trying to create wealth through fixed deposits. It wouldn't have been so bad in the last couple of years. If you were an equity investor, you would have had a very tough time if you were in Indian equities from 1997 till 2003. You would have had a tough time again after the global financial crisis from 2008 till 2013. Now, 2014 to 2024, I think you've had a very good run in the equity markets. If you were a global equity investor, you would have had a tough time after the dot-com bubble from 2000 to 2005. And then again, if you were an investor in gold, right, you had one cycle of no returns from 2011 to 2019. So there's a lot of talk about precious metals today. But in 2019, people were not really interested in looking at gold as an asset class, right? You had almost 1 decade of no performance. So every asset, no matter how important it is, no matter how uh, much you favor it, can go through these long cycles of no performance. So we need to be prepared for a scenario where we understand that, okay, any asset class, it doesn't matter whether it's fixed deposits, it doesn't matter whether it's equities, it doesn't matter if it's global, precious metals, commodities, every asset class is going to go through a cycle where nothing really happens. And this again is about to understand where we are in a particular cycle. So for those investors who actually spend time on mutual funds, you can check out every AMC's fact sheets, right? So they all have their own metrics, they all have their own ways to assess where we are in a particular cycle. This is from ICICI AMC, where they actually show you, okay, if you're going to invest in equities or fixed income, where are we in the market for you to do that? So this is like you can think of it as like a heat map or a temperature check, where the red zones are areas where you need to move out of equities into other asset classes like fixed income. The neutral zone is broadly like a either equity or fixed income zone, which is yellow. And then the lower areas are when your equity valuations actually become more and more attractive, and investors can start investing in equities or being more aggressive with their equity investments depending on how attractive valuations are. So some key points to look at this in this chart. If we look at 2008, for example, you had the global financial crisis, 2008, 2009, your equity valuations were very, very cheap. And so you can see that the black line is in that zone of allocating more to equities. If we look at where we were again in 2019, so 17 was your bull market. You had money, 17, 18 was your bull market. So you had a lot of money going into equities. Then you had the market like cool off, correct, and then you had a cyclical slowdown kick in 2019. So again, there your equity valuations dropped quite a bit. Then COVID happened, markets heated up. You had one round of correction in 21, 22, or rather 2022. Then markets quickly recovered. You had the India story and all of that come into play. And now market valuations have been quite expensive. So if we look at how analysts have been perceiving Indian markets, they've been rather expensive. We also are cognizant that, okay, growth is slowing down. So can you really pay these expensive valuations for businesses, right? So that's a big question mark. So today, again, we're in the zone where we can be neutral, but neutral depends more on how your incremental data comes in, what your corporate announcements are going to look like, and what your monetary policy is going to play out as, right? In terms of, does it make sense to allocate more to fixed income today or less? So now I'd like to talk about how an investor can actually win in all markets. When we talk about winning in all markets, what we're trying to understand is that there are different ways to create wealth, right? You can be a mid cap investor, you can be a small cap investor, you can be a quality large cap investor, you can be somebody who participates in global markets, You can be someone who's aggressive in fixed income, taking credit risk. You can be someone who's very conservative in fixed income, looking at only high quality corporate bonds. You can be someone who looks only at government securities, or somebody who's a precious metal investor like gold. So if we look at the last 10 years, right, and this is data that LiveMint publishes every year, where this is called their quilt. And the quilt essentially shows you how much each of these asset classes return on a calendar year basis. So what we can learn, I'd like everyone to pay a little bit of attention to this chart. It's color coded. So if we look at the top performing asset classes, right, in the last column, you have the 10-year compounded annual growth rate for these asset classes. So if we see what's come out on top, right, the top half of the table is all equities. So it's mid cap at 19% compounded, followed by small cap, followed by your international equities, followed by your large cap. In the bottom half of the table, you have your precious metals, you have your fixed income categories, and finally you have real estate. So if we look at how these asset classes have performed, the last decade has really belonged to equities. And this was something that I had mentioned earlier, but this is something that we can sort of revisit and look at what the data actually tells us. So the real question is, if cycles exist, who does the next decade belong to? Right? What asset class is actually going to do well in the next 10 years? And we need to keep our mind focused on that. And even within equities, we can look at what has actually done better than the others. So here's why we think asset allocation actually works. There are three reasons, or there are three big lessons that we can take away from this chart. Okay. So the first is, and I go back to the chart so that you can see it. The first is, there are no years where all your asset classes underperform, right? And to sort of judge that, we're going to look at the top row in this table. Is there any year in which the top number is negative? Because the number, like the columns are in descending order, right? So your highest return item is on top, and then gradually everything that's lower is ranked below. So your top performing assets are always positive, right? And it's not just the first row. If you look at the first 4 rows, 5 rows, 6 rows, 7 rows, you're kind of comfortable. It's only in the bottom 1 or 2 rows that you're seeing some sort of negative performance. That's the first important takeaway. The second important takeaway, and I'd like everyone to do this counting exercise, is to look at the bottommost row in this table and see how many years in which you had a negative return in the bottommost row. So if we do that counting, and it's going to take you about 10-15 seconds to do that, you're going to realize that about half the time, right? So 5 out of the last 10 years, you've had positive returns in the bottom. So that means only like half the time, all of your assets are actually giving you positive returns, which is another great validator. And that's why I was explaining when we were talking about the asset allocation clock, we might think that things fit into a clock very nicely, but cycles are not so clean cut, and actually assets tend to perform even if they're not in the classic or cycle quadrant. So this is why asset allocation is really important, because you're going to have performance from different segments no matter what's going on. So the last thing is that losers can become winners. So let's take a look at, let's say, mid caps, right? Because that has been your top performer in the last decade. You started off 2015 with a great number, meaning top of the pile. But 12 can have like a reasonable return expectation, right? 12 to 15% compounded is like a reasonable return expectation from mid caps. The next year was rather underwhelming at around 7%. The following year did really well. It made up for the bad year and the average or below average performance in 2015. So you made up for your mid cap returns for that year were around 50%. Now, next year, did you have great returns? No, right? So the next 2 years were actually quite bad for mid caps. So what we can understand is that performance goes in cycles. So you can have returns that come for that make up for a couple of bad years, and then you have returns that make up for a great year, right? So you have negative returns that compensate for having a really amazing year in the markets. So if we look at this, mid cap was on the top of the table in 2015, somewhere near the bottom in 2016, again back to the top in 2017, and then it hovered in the bottom for 2018 and 19. Then it came back to the top of the table in 2019 and 20, then moved again very average returns in 2022, and then again excellent returns in 23 and 24. So when we look at this, you can clearly see that there's no pattern in terms of how long a cycle is, but you can see that there is a cyclical nature to the returns, which is the most important thing to take away from the conversation today. So cycles occur, they're unpredictable, but they're visible, and we need to be careful because after a long run of good performance, you're going to see underperformance. And after underperformance, you're actually going to see good performance. So mentally, we need to be prepared that our portfolios are going to go through these cycles. And as the portfolios go through this cycle, we need to adjust and rebalance and move to different set of ideas so that we can rotate our winners. So now let's try to understand why asset allocation really works. And I think the first reason that multi-asset investing works is that it actually suits a wider range of risk profiles. So when we talk about the behavioral cycle, in multi-asset investing, you're going to have performance coming from one of your multiple engines at any given point in the cycle, right? Which means that the returns are a lot more stable. At the same time, it does not mean that your returns are lower, right? There's a common misconception that if you take higher risk, you're going to earn higher return, and if you take lower risk, then you're going to earn lower returns. That's not true. You can earn very decent returns by playing a low risk strategy. You can take an extremely aggressive risk strategy and lose a lot of money. So both things are possible. We just need to strike that balance between risk and return, and multi-asset investing actually helps a lot of investors strike that balance. The second thing is it also exceeds the moderate investors' return expectation. Most investors who want to compound in the long run are looking to double their money every, say, 5 to 7 years, right? So if you're looking at that time frame, then you're looking maybe at a 12 to 15% compounding rate. Now, if you're at 12 to 15%, I think multi-asset investing can comfortably do that for you. Whereas if you did, say, mostly like fixed income, you're going to be at a much lower return profile rate. And the biggest advantage for an investor is that you can continue to participate in the markets regardless of what valuations are looking like, what macroeconomic data is looking like. Is it going to be a year of high inflation, low growth, high growth, a recession? Regardless of what is going on in the markets and in the economy, you're going to be able to participate because there'll always be one asset class which is or one or more asset classes that are favorable. So now for the more mathematically inclined people, we're going to talk about how we can beat volatility with mathematics. So the key problem that you have is if an investor is looking at their portfolio and the portfolio value is constantly changing, then it's going to keep them a little bit cautious about whether they should participate more. So the most important thing for an investment solution to do is to beat market volatility. So you want to ensure that you're not going through these large ups and downs and taking investors on this roller coaster ride. So how can you actually avoid this roller coaster ride? It's pretty simple. In maths, there's a concept known as correlation. It basically measures how much two things move together, right? So if A happens and you have items P and Q, are they sort of running together in the same direction? Are they moving in opposite directions? Or is there sort of no predictable pattern? So if we want to take this concept of correlation into portfolio management, you want to put assets that have low or negative correlation or no correlation together. Because when you're able to do that, you're actually going to create a portfolio that performs in different markets, right? So just to explain how correlation is, the leftmost chart shows you a perfect positive correlation. That means both items actually move in the same direction. That is, let's say you own a stock and a bond. The stock and the bond price move in the same direction. So if the market is up, both the stock and the bond will move up. If the market is down, then both the stock and the bond will move down. Uh, if there's a high positive correlation, this will not happen in the exact same manner for both. There will be some difference, but it will broadly be in the same direction. When there's a low positive correlation, then you don't really, both will move up, one will move up significantly more than the other, right? When there's no correlation, you can't really tell what's going on, or there's no pattern to this movement, right? When there's a low negative correlation, again, one will move up, the other will move down. When there's a high negative correlation, one will move up, that movement will be more visible and more pronounced. And when it's perfect, that means it will be in exactly opposite directions, right? Um, so this is what correlation does. And when we look at the correlation between assets, and this is something that Bandhan Mutual Fund has published, where they've tried to say, okay, what is the correlation between, say, the Nifty and the MSCI ACW, right? So that's your global index. And there's only a 0.2526 correlation, which you can say is like a moderately low positive correlation. But when you look at the correlation between the Nifty and gold, it's actually negative, right? And when you have negatively correlated assets in a portfolio, they tend to do much better because when one asset is falling, the other one is actually going up, right? And that means your performance is not going to be fully negative. There's going to be one portion that is positive, which is compensating for that loss that you're making in the other portion. And if you look at the Nifty with short-term debt, then that correlation is low positive correlation, right? You are only seeing a 5% correlation between Nifty and short-term debt. So what is the case that we're making here? It makes sense to have all of these assets in one portfolio together, right? The Nifty is just one equity index. You can obviously try to get this data for any equity index or individual companies and see how they're working out together. So now that we've understood correlation, we also need to look at asset allocation as an art in itself. And here, what we're looking at is when we saw the behavioral cycle, we saw that investors were getting trapped, right? And performance is actually something that traps investors. And again, this is something from Bandhan Mutual Fund, and we're going to look at a very simple portfolio where you have three assets, A, B, and C. In year W, A is the best performing asset. In year X, B is the best performing asset. In year Y, A is the best performing asset. And in year Z, C is the best performing asset. So if an investor makes decisions based on how an asset actually performed in the previous year. That is, you go back to that chart, you look at what did the best last year, or you're looking at 1 year, 3 year, 5 year returns, and you're making a decision, right? And a lot of investors are actually using this as a framework to make their choices. Then what tends to happen is you're chasing last year's performance by investing in the best asset class from last year. When you chase performance, your compounded return, that is, if you have an equal weighted portfolio, that is, you buy A, B, and C in equal weights, then there's almost a 1% differential or a 1.5% differential in how much you compound. So chasing performance actually is a very, very costly investment strategy. And investors need to steer away from that. A simple way to avoid chasing performance is to equal weight, right? But a better way is to cyclically adjust. And these are all very simple options that are available to an investor. So now we move to the last part of our presentation, which is how do we actually do well in different environments. So what we need to understand is that each asset is unique and each asset does something special for us. So if you're looking at domestic equities, it's going to create a lot of wealth for you because if you look at the long-term track record of equities as an asset class, it has done a phenomenal job in terms of wealth creation. When we look at foreign equities, it gives us this geographic diversification edge, right? So if you're in an economy that's slowing down and that's sort of going through a slump, then you want to be participating in another economy that's actually growing and doing well. So foreign equities basically gives us that edge of harnessing the power of equities, but not in our own location. When we look at short-term debt, the main advantage that it gives you is portfolio stability, right? So no matter what happens, it may not be earning a lot of money, but it definitely gives you a sense of comfort and predictability as to where your portfolio is going to go in the next few months or couple of years. When we look at long-term debt, you're actually looking at getting more income or yield from the portfolio. When you look at precious metals, they're a store of value. So, in a high inflation environment, precious metals can actually bring out or retain some value that they have. When we look at commodities, you see these cyclical returns based on your inflation cycle. So now we also need to look at assets in terms of what are we worried about? How can we turn those worries into opportunities? So domestic equities actually have a high growth uh, kicker, right? So this means that if you're worried about not making enough, if you're worried about whether you're going to hit your wealth creation targets or not, equities are a great tool. When you look at foreign equities, they actually help you manage currency risk. So if you're someone who is saving for their children and you want to send them abroad for their education, then having some foreign equity exposure actually makes a lot of sense for you. If you're someone who's looking more at having liquidity and flexibility in today's market, maybe you have short-term goals coming up, maybe your life is changing in a lot of ways, and you just want a little bit more flexibility to make things happen smoother, then you can use short-term debt. If you're worried about how your portfolio is going to perform, whether you're going to see big drawdowns, then you can look at longer term fixed income solutions, which can add to your portfolio stability. If you're the kind of person who wakes up, reads the newspaper, and then sees that so and so country has gone into war with somebody else, so and so is going to impose tariffs on someone else, then I think you want to hedge against all of the uncertainty that's there in the world. Precious metals work really well for that. If you're in a cycle where inflation is way out of control, then commodities are the solution in that case. So now I'm going to walk you through where the magic happens, which is Sphere, and Sphere is our PMS product. So we're going to start with how we make asset allocation work for you. So number one, we're very conscious of valuations, which means that we are trying to be as careful as we are about paying the right price for the right asset. We also are contrarian in nature, which means we stay away from the crowd, and we're very patient as investors and fund managers because we know that good things come to those who wait, and the best results come from planning and thinking in a more long term manner. The last thing that we've learned is that a little bit of everything works, and that has been the essence of the message that we wanted to deliver today. So when we look at a traditional multi-asset fund versus Sphere, what is it that we're actually doing differently? I think one, we don't have the same allocation limits as a mutual fund, meaning we're not trying to achieve a certain level of tax efficiency for the investor or at the fund level. So we can have very flexible allocation limits, which gives you a lot more protection in down cycles and a lot more performance variation in up cycles. We are also sorry, this is yeah. So then mutual funds tend to be more tax efficient because they compromise on their allocation flexibility, and they look at very simple vanilla sort of ideas. If we look at what Sphere is doing, there's more investment flexibility. We're very tax conscious, which means that we come in with a longer term mindset and we ensure that clients are looking at only longer term capital gains, right? As much as possible, we try to avoid trading and churning in the portfolio so that you have a more tax efficient portfolio at the end of the day. There are a lot of out of the box ideas in Sphere, and those who are investors will be exposed to them. Those who are curious about this can always contact us to know more about what our out of the box ideas are. So we have very happy clients. They're all quite satisfied with what we've been doing, how performance has been, how the risk management has been, how the process has been outsourced. And we've also been able to outperform our peers in the long run. So the first blue line is Sphere's performance. So as you can see, in the last 1 and 3 months, we've been a little bit on the underperformance side. But even if we benchmark against certain peers, we have outperformed some of our peers in the near term. If we look at our longer term, and this is where we really tend to divert our focus and attention. In the long run, we've actually outperformed all of our peers, whether it's the benchmark index, which is your Nifty multi-asset, that's the orange bar, whether it's a pure equity index like the Nifty 50, or if it's um, dynamic asset funds or multi-asset funds as a category, as well as FlexiCap as a category, we have actually done better than FlexiCap as a category, except in the 2 year bucket, I think, where we're very neck to neck. So, by and large, I think on the performance side, you're able to show that something like a multi asset strategy can actually deliver great returns for an investor. If we look at our drawdowns, that is now, we've seen the upside, now let's look at the downside. What if things go really wrong? How are we stacked against that? We've definitely fallen. So this is our maximum drawdown. We've definitely fallen more than the multi-asset index. We do have a higher allocation to equities, so that makes sense. But at the same time, if we benchmark against a pure large cap index like the Nifty, we've actually not fallen as much as the Nifty. And the last few months, like I said, have been very volatile in markets. So here, if we look at where we are, Sphere and Neo are our multi-asset PMSs. Neo is strictly for NRIs. Sphere is for resident investors. So here we've fallen about 7% because September 26th till November 21st was the longest drawdown phase. And then we fell more than the multi-asset index, less than the Nifty. And like I said, I just wanted to illustrate that you have a negative correlation between gold and equities in certain contexts. So here your gold has actually performed in a positive manner. Silver has been slightly negative. So this is our performance data as of December 31st. Like I said, in the 1 and 3 month window, we've not been beating the index, but we don't focus too much on short-term performance. Our focus is more on long-term, and we've been around for the last 3 years. And these are the terms of our investment. We are a SEBI-registered PMS, so the minimum investment is 50 lakhs. We have a lot of investment flexibility. It is a flat fee product, which means you don't pay extra for performance. And there is no exit load. It's ideally suited for an investor who comes in with a 5 to 7 year time frame. And I think with that, we'll open up for questions. We have a lot of people working on our PMS services. And here we have other products. So Solitaire, True Blue, Sphere, Neo are all part of the ecosystem. So anything that suits you, you can always reach out to us and we can talk to you more about these products and how they can work for you. So with that, I'll open up for questions. I think there's already something in the chat box. So let me take a quick look at that. But anyone who's interested, please type in your questions in the chat box and we can take it together. So the minimum investment that's required is 50 lakhs. We are a SEBI registered PMS and that minimum is mandated by SEBI. It's not something that we have internally set as a benchmark. We do not have an AIF service. What is SIF, ma'am? Could you please expand that? Specialize. No, so we run PMS products. So like I showed you in this slide, we have a flexi cap fund which is solitaire. We have a pure large cap fund or true blue chip fund which is true blue. Then we have a small and mid cap fund which is Vriddhi. And then we have multi asset fund which are Sphere and Neo. Neo is suitable for uh, NRIs. We also do financial planning, and under a separate entity, there is mutual fund distribution that happens. So these are the broad services that we engage in, and we don't have an AIF or special situations fund. So Neo does not have mutual funds in the portfolio. Sphere does. But broadly, the idea is if you're looking at the same macro context, the portfolios will be similar. There can be a few differences in terms of the stocks or the holdings, but broadly, the asset allocation will look similar across both products. Can I see my portfolio performance every day? No, we do not have a system or access for the investor to see their portfolio every day. We also do not encourage that because that can trigger a lot of investment behaviors that are not required for long term wealth creation. Yeah, as of now, we do not have the new SEBI fund that is open only to asset management companies. So you'll have to check with a mutual fund house as to whether they have that or not. We aim, so moving on to the next question, how much could we expect returns in the next 7 years? So I think we aim to compound at a rate of say 15%, 12 to 15% in that bucket. As you can see from our performance numbers, we've actually done better than that. So if I show you our 3 year performance, it's about 22%. That's not what we're aiming for. What we're aiming for is more in the bracket of 12 to 15. If we manage risks effectively and the market is also very supportive, if we can definitely do more than that. Sorry, I wasn't familiar with the abbreviation. If markets are going down and it is still mandatory for Sphere to have stocks, there is no mandate, right? Meaning we are not like a mutual fund. So in a mutual fund, there is a mandate that 65% should be in equity if you want the investors to receive equity taxation. So we can theoretically move more into fixed income or other asset classes. We don't need to be 100% in equity or have equity exposure, but I don't see any situation where zero equity exposure makes sense. After all, we are value investors. We have been in the markets for multiple cycles. In every cycle, we have always had the ability to find good, safe investment ideas on the equity side. And I think that is something that will be there in the portfolio. Also, but why every program of your guys is focused only on PMS? Not all can afford 50 lakhs. I think there's a misunderstanding on what we do. We have about 4 webinars that happen, 3 to 4 webinars that happen on a weekly basis. Some of them are focused on the PMS product. So if you've registered for the Sphere, TrueBlue, Solitaire webinars, you will see a lot of data around the PMS. But we also work very closely with small investors in a program known as Milestones to Wealth. Milestones to Wealth also does 1 to 2 webinars every week. So you can sign up for that. That is completely oriented towards the small investor. And the idea there is to ensure that no matter where you are in your journey, we will work with you to get your first crore in financial savings. So if you don't have that 50 lakhs ticket size and you still want a multi-asset experience, then please reach out to us. I'll have Gopi, my colleague, put in the Milestones to Wealth details here, and you can sign up for that program. And definitely, if there's anyone else also who's interested in something um, that is not requiring a 50 lakh ticket size, uh, definitely we are able to service you through that product. Yes, if you register, if you sign up in the portfolio management site, we will send you monthly statements. In your monthly statement, you can see your portfolio value. That's correct. So our aim of 12 to 15% is what we think is a long-term sustainable solution, right? Uh, this is what we think for 10 years, 15 years, we can expect investors to compound at this rate. We can do better. You can see that from the data also that we have shared, that it is possible to do better. But this is where we like to anchor investor expectations. Because if I tell you that we're going to do higher returns, and it's not sustainable, right? Like I don't think 20% CAGR is sustainable on a 5-10 year basis. It's not possible. You might have phases in which you earn that much, and you'll have phases in which you're doing something more average. Okay. Are the funds for NEO only accepted through NRE accounts? Do you help with tax disclosures and FBAR regulations abroad for holding funds in PMS? We are supposed to pay tax in abroad for capital gains. Uh, so you can invest through either NRO or NRE in NEO. We don't do tax consulting. So if you need, so there's a standard tax capital gains report that will be shared on a quarterly basis that can be shared with the investor. But something like specific to certain regulations or formats, maybe we will not be able to support that. But based on what your actual requirements are, we can get on a call and see if it is possible or feasible to get the reporting in the format that you need it in. Uh, how do I withdraw money partially? Once you onboard onto Sphere, as long as the portfolio value remains above 50 lakhs, we are compliant with PMS regulations. So any withdrawal that will not bring the portfolio value below 50 lakhs can be processed. You just have to write to your point of contact and the PMS team, and they will process the redemption accordingly. Based on the settlement schedule, uh, you should be able to get the this thing proceeds in your bank account. What do you mean by this, sir? I hope the corpus has to be 50 lakhs and not the investment. I'm not sure I fully understand this question. So I'm quickly moving to the slide with our contact details. I feel like a few people have expressed some interest in terms of the work that we're doing. If you need, um, if you need more information, or if you like to talk to us in more detail and have a more personalized discussion, please drop us a message on WhatsApp at 9500027285. That's our WhatsApp number, and we'll be happy to get in touch with you. Are ETFs part of NEO? Yes, they are. But if, for example, ETFs are not suitable from a tax compliance perspective, then you can have that as a restriction in your portfolio. But ETFs are a great way to get multi-asset exposure as well as global exposure. I mean, thank you. So I can see some people are dropping off. Before that happens, I would just like to thank everyone for coming in and spending 1 hour with us to talk about wealth creation. We do these webinars regularly across different um, brands from ithought, and it's been a pleasure talking to you. If you ever want to reach out to us, please feel free to use the Milestones to Wealth link if you're interested in Milestones to Wealth. Gopi has actually shared it on the chat. or drop us a message on 9500027285 and we'll get back to you. Thank you, sir. Thank you, everyone, for appreciating our work today. We enjoy talking to investors. Yes, the 50 lakhs has to be given at one shot to the PMS, meaning, I mean, from an operational perspective, if your transaction limit is only like 5 lakhs, then you can do it over 10 days. But the basic idea being that the investing can start only once the corpus of 50 lakhs has been reached. Yes, sir. I mean, with us, we work a lot towards the investor's best interest. We try to keep it safe. There can be some volatility in the portfolio, especially in the early phase of building it. But definitely over a 3-year horizon, I think you can see that the compounding is going to happen and it has happened in a very effective manner. Our entire process is oriented towards managing risks better. So, to the best ability, we try to avoid taking too many risky bets. We definitely pay a lot of attention to what valuation we are buying ideas at. And we don't churn the portfolio a lot. So anything that we buy with a longer term mindset so that you can compound very effectively. I don't think we'll decide to close down. We've been around since 2010 and we have been built as an investor company. You've not really seen any wealth management firm close down, right? Acquisitions happen, it changes hands. So if we're looking, you had Wealth Advisor that got acquired by IFL. But I don't really see us closing down. The team is very committed. If you look at how long people have been in the firm. I've been here for the last 10 years. A lot of people have been here 5+ years. So employee retention is very good. We're all very focused towards working with investors. I don't really see this as a risk. You can definitely go and see on LinkedIn also. If you look at the employees, you can see how long all of us have been here. Core team has been here for a very long time. How are the profits taxed? The profits are taxed at the investor level, which means same capital. If something is bought or sold in your account, then whatever your normal capital gains rate will only get applied. So typically it's 20% for short-term transactions and 12.5% for long-term transactions. If there is a fixed income element, then it is at your slab, right? So whatever your tax slab is, that is the rate at which it gets taxed. Every year, the notional profit is added to the personal income of the investor. No, this is not true. Unless we realize any capital gains, that is not added to the income tax of the investor. I hope I've answered your question on how safe your money is. If there is anything else you would like me to elaborate on, I can talk about that. So I can still see this, and I'll take this as the last question. Please or fees charged by the PMS. So we run a flat fee model in Sphere as well as Neo. The flat fee structure is 1.5%. That means it's 1.5% for the year. The fee is recovered on a quarterly basis and it's charged on the daily portfolio value. So this ensures that if it's a good year or a bad year, it doesn't matter. And it's not based on any specific date of that particular year. On your daily average AUM, this 1.5% per year is charged on that. Right? The fee is recovered on a quarterly basis. Over and above this, there are no other fund management fees. Right? You are liable to pay GST on the fee because this is a service. You are also might have to incur some one-off expenses or charges in terms of custodian fees, etc., which is very nominal. So this is the and that is like, so your security transaction tax, your custodian fees, these are all things that would get applied regardless of what who your PMS provider is or what they are doing, right? Uh, so the fund management fee is only 1.5%. And to clarify, like if your portfolio performance is say 10% in 1 year and 20% in another year, the fee will still be 1.5%. It will not increase because you have earned more returns. So the returns are left on the table for the investor to benefit from. All right. So I've taken this as my last question. If there is anything, if you're more interested, please do reach out to us. You can ask directly for me, and I'll be happy to talk to you or set up a one-on-one call to discuss your investments and how we can take this forward. Once again, thank you everyone for coming in. I'm sorry I overshot by 10 minutes. Perhaps I should have started exactly at 11, but thank you. It's been a really wonderful session for us. Thank you, ma'am.